Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Okay, welcome to The Wealth Flow. My guest today is Arn Cenedella. He is a real estate broker and an investor with over 4 decades in the industry. Starting in 1978, Arn built a thriving Silicon Valley residential brokerage business in Palo Alto and Menlo Park, California. I may have butchered that.
Menlo Park, yeah.
There we go.
All right, yeah.
While building a sizable portfolio of single-family residential properties in the Bay Area. In 2020, Arn transitioned his single-family portfolio to multifamily investments and founded Spark Investment Group to help busy professionals and parents reap the benefits of commercial real estate investing without the hassle of operating the properties. Arn currently manages and operates a multifamily portfolio as general partner and sponsor of over 1,100 units with a total value in excess of $138 million. So Arn, welcome to The Wealth Flow.
Yeah, hey Keith, thanks for having me. Look forward to having a nice chat and hopefully provide your listeners some useful content that will help them on their investing journey.
Sounds really good. I like to start with where you grew up and really what led you to a career in real estate.
Well, sure. Great question. I was actually born in Marysville, California, which is above Sacramento. My dad and my uncle owned a farm. My cousin Jill still runs the family farm, about 640 acres in Marysville. But at about the age of 1 year, my family moved to the San Francisco Peninsula, and I grew up in Los Altos Mountain View, which is basically Santa Clara County. When I was a little kid, Libby Canned Food Company was the biggest employer in Santa Clara County. And of course, we all know Santa Clara County is now Silicon Valley. And so I was blessed to, kind of live in a really exciting area. Middle-class family. Parents said, work hard at school, do well, get a degree. And that's what I did. Ended up getting a master's degree in physical chemistry of all things. I was trained as a scientist, thought I maybe wanted to teach, graduated from the University of Michigan, but wanted to return to the San Francisco Bay Area where basically I grew up. And my dad at that point had a residential brokerage company in Menlo Park, California. And I was ready to kind of leave the academic world. And he said, hey, come on out, get your license. I'll put you to work. And that was March of 1978. So there was no grand plan to get into real estate. I kind of fell into it. And basically my entire adult life has been spent in the real estate industry. So that's kind of how I got started. And was fortunate to have my father as a mentor, both in the brokerage business and also the investment business. So, unlike many brokers in the real estate industry who can make high incomes, my dad kind of understood using those incomes to create capital to invest in real estate is really the way to create financial security and long-term wealth and a legacy. So it was a good lesson. I was blessed to be able to sell property on the San Francisco Peninsula, probably the best real estate market in the world, and have now transitioned to multifamily, but we can pick that up later.
Yeah. No, that's a great lesson from your dad. So was your dad investing also then in real estate or primarily brokerage?
Yes. So he basically was a big real estate investor, and he bought single family homes. And,
Okay.
if you go back to the 1970s, it's a long time. Most of your listeners probably weren't around back then. Prices in the Bay Area were not in the millions per house. They were still 100,000, 200, 300. So you could actually buy things as rentals. So he was a single family rental investor, never went to multifamily. He then moved to kind of multi-tenant office buildings. And as I got into the business and as my brokerage business grew and I had income and capital to invest, I kind of followed in his footsteps and started buying single family homes in the Bay Area. And then the other market I got into was Austin, Texas. And of
Mhm.
course, I think we all know what's happened and what is happening in Austin, Texas. And interestingly enough, my dad never went to the multifamily or apartment investing, single family and office. I've never done anything in office or retail, so I've kind of gone from single family to multifamily.
Okay.
Yeah.
And what? Well, we can get into the story as to why the Austin market, from kind of investing. Were most of your single family investments right there in the Bay Area?
Uh, Initially at the start, yes, they were. So I
Okay.
probably ended up with about 10 or 15 of them. And I self-managed them. I was in the real estate business. I wasn't at a location 9 to 5. I didn't have
Mhm.
3 meetings every day at the corporate headquarters. So basically, I weaved my investing business into my real estate sales business. And of course, many of the people that I interacted with and built relationships, my vendors and so on and so forth, title companies, attorneys, lenders, they all played roles in both the investing and brokerage. So I had the freedom to manage these properties myself, which a lot of, say, 9 to 5 corporate employees don't have the flexibility and freedom to drop everything and run out to a property if the hot water heater breaks or whatever it may be. So I was fortunate in that the aspect I wasn't tied to a desk and I could keep an eye on my stuff.
Yeah.
Yeah.
And Arn, when did you really see, since you were in that market and really intimately know it from the beginning of your career in real estate, when did it really start to take off? Is it during, kind of the tech bubble or what? When did it just completely skyrocket?
Yeah, yeah, that's a great question. So, um, let's see. I got into the business March of 78, and the market was starting to heat up. Uh, One of the things that happened way back when is fair housing laws were passed, and this sounds crazy today, but back in the day, for qualification purposes, a wife's income was discounted. It's an absurd, archaic
Hmm.
policy. So, about 75, the lending policies kind of changed. So, the market was starting to take off at that time. Um, Bought my first house in 1980, actually paid 11.75% interest for a mortgage. At that time, rates went to 16.5, 17. And of course, that put a little bit of a damper on the market. So I would say in the late 80s, market started to explode. Then by the time you got into the mid to late 90s, you had kind of the dot-com boom. And then we had kind of a dot-com bust. So I would say from about the mid 80s, basically through 2020, the Bay Area real estate market's gone crazy. And basically what's happened to the San Francisco Bay Area, like a lot of other major metros, is it's a world market, meaning people from all over the world, India, China, Europe. If you have some wealth and you want to kind of make your fame and fortune, where are you going to go? You're probably going to go San Francisco Bay Area, maybe Los Angeles, maybe New York, right? And those are kind of the really wealth generating areas. So the San Francisco Bay Area became basically a world market. And when you look at the populations of, say, China and India, it's a lot of people. And if you only take the top 1%, that's still a lot of people. And of course, in general, international investors are attracted to U.S. real estate, partially because the strength of the economy and the economic vitality here. But the other part of it is the safety of their capital. We still have pretty strong private property rights here. And so investors from other areas in the country, other areas in the world that may not have the same personal property rights, they love to get their assets in U.S. real estate, which they believe to be secure and safe.
Yeah, makes sense. And so you spent time there in real estate and really saw that market grow. And along the way, amassed a good sized portfolio of single family. When did you decide to make a shift to multifamily, and what caused that?
So in about 10 years ago, Laura and I moved to Greenville, South Carolina. We love California. She had a tech career. She worked for Intel, Visa, and Intuit. Not that she was a techie, but she worked for some great companies and benefited from the strength and generosity of those countries. But we had reached a point where we wanted a little bit slower pace of life, a little more relaxed lifestyle, a little bit less expensive lifestyle. So we moved to Greenville, South Carolina, clear across the country back in 2014. And when I got here, great market between Charlotte and Atlanta, economically vibrant. BMW's here, Michelin is here. There's a lot of really positive factors. Plus, it has a great downtown. So when I first moved here, I kind of continued the single family rental investing. Prior to the move, I had bought in Austin, Texas, and over time, I liquidated stuff in Austin and the Bay Area and moved to Greenville. And had a chance conversation when COVID hit the United States, March of 2020. I remember it to this day. A young investor friend of mine called me up and said, what do you think is going to happen with rent collections? And I said, Mario, well, talk to me April 5th and I'll let you know. This was about March 15. And at the end of the conversation, he gave me a podcast from another Bay Area guy known as the mad scientist of multifamily, a guy named Neil Baba. And listened to it, and I was kind of hooked on it. And I'd been doing single family for about 40 years, literally. And I was just ready for a change. So part of the reason I went to multifamily was it's still residential real estate, but it's a little bit different. So I have a level of expertise. It wasn't like I was going to buy shopping centers. I just went from one form of residential to another. Uh, the other part of it is with multifamily, it typically is more a team effort where you have groups of 3 or 4 people who are operating or running the total multifamily operation. And what that allows you to do is do what you are best at, do what you most enjoy, and have partners that fill in the missing skill sets.
Mhm.
The who like to do some of the stuff you don't do. And so for me, at my stage of my life, I'm a senior citizen, let's say. I really enjoy the partnership aspect of it. And so I have 2 great partners who do the things that I don't like. I love finding deals. I love talking to investors. I have one partner that does a great job running the apartment building, collecting the rent, doing the repairs, doing all that day-to-day stuff that I consider drudgery, but he actually enjoys doing. And then with my other partner, Dan, who now lives in Cary, North Carolina, um, he's a CFO. He just resigned his position after 30 years as a CFO of a internet advertising company, experienced investor. And so he kind of handles the financial, the analytic, and the accounting aspects. So teamwork's great. The other thing I would say is uh, as I've gotten older, uh, there's always this debate in real estate about cash flow versus equity growth and appreciation.
Mhm.
And people have strong opinions about both. I would say as one starts to get older, and has accumulated a certain net worth, maybe the scale starts to tip towards cash flow from appreciation, where in my mind, if somebody's 25, just starting their career, 30, focus on building your net worth, focus on building your investable capital. You have a good W-2 job. You may not need the cash flow now. What you're really building for is what your life going to look like in 10 or 15 years. Um, so with multifamily, you have these economies of scale. You have 100 rental units all in one location. So it's a lot easier to keep track of than 100 single family houses all over the county or whatever. The other part of it is I think we all understand housing affordability is an issue. Uh, the supply of housing, we don't have enough of it. And I would submit most of the lack is in the more affordable range. And when you think about it, what's kind of the most affordable housing you can have is probably apartments or maybe mobile homes. So, in my point of view, as an investor, you have this huge demand for relatively affordable housing that
Mhm.
multifamily properties provide. And so you're always going to have that demand. I believe there's always going to be a lack of affordable housing. So that sets you up well to have a product that's in high demand and can generate kind of consistent income. And we mentioned the economies of scale. I think that's great. And so I think multifamily fits a really important niche. And I love it. I still own a few single family homes, but most of my real estate capital is now invested in multifamily.
Okay.
Yeah.
And that's great. So, yeah, I didn't know back then Neil had the, I guess he's probably had that for a little while, but he's been a guest on our show as well, and really enjoyed the conversation with him. Uh,
Yeah, he's a great guy. And when I went to multifamily, he has something called Multifamily University. intense 2-week course, 3 hours a night, 5 nights a week. When I took it, COVID was front and center, so it was online. But prior to that, it would be in person. I think he's since become too busy doing all his deals that I don't know that he offers the same training. But yes, it was really good training. And the fact that he's an ex-Bay Area guy was kind of sweet too.
That's right.
Yeah.
And so you mentioned having a team, and I think that is important. And it is one of the, you hear it from multiple people that we've had it on the show as well. It truly is a team sport. When you were putting together that team that you mentioned, how did you come about these? Were these people that you already knew that were other investors, or how did you kind of put that team together?
Yeah, good question. And I think with most business people and syndications of business, multifamilies of business, you kind of jump in and the business starts to grow and you see a need and you fill it. So at least for me, there was no great master plan where I had it all whiteboarded out as to what I was going to do. So I'm very active within the Greenville community where I live, especially within the real estate investor community. And one of my first acquisitions here in Greenville, I bought a duplex 2 blocks from my house. And the person who I was interacting with, it was kind of a wholesale deal, was a guy named Brian Walsh. And he has a property management business, and this was probably about 7-8 years ago. So through that transaction, I got to know him. We kept in touch. We developed a friendship. And then I started it. One of the reasons I left single family, I was self-managing. And I was just getting a little tired of that. It seemed every time I was going on vacation, as I'm running to the airport, I'd get a call. The furnace went out, and no big deal. You get on the phone, you call your HVAC guy and everything's cool. But I got less and less enamored with that kind of stuff that goes with self-managing property. So I started turning over my smaller properties to Brian, and that started to deepen the friendship. I saw he was doing a great job with my properties. Every month I got a check. I rarely was hassled or bothered with any issues. And I'm going, why didn't I do this 5 years ago? But I thought, who could do it better than me? Of course, that's just ego talking. He can do it better than me. And so when I started going to multifamily, I knew I wasn't the greatest operator. I wasn't the greatest property manager, and I didn't want to really do it. I didn't enjoy it. And so before I could go out to other friends, my social, my professional sphere, and ask them to invest their hard-earned capital with me, I knew I needed to have a strong operator. I could find the deals, I can raise the capital, but if I'm asking people to trust me and invest their capital with me, I need to know I have the operation nailed. And so I started talking to Brian, and he came from the single family background like I did. He probably has 15, 20 single family rentals. He has a property management business here in Greenville, 10 employees, probably manages 550 units. And he said to me, Arn, I'm a single family guy. I'm doing great. I don't really see any reason to change. So I just kept working on him a little bit. And every now and then when I'd see something that I thought was good, I'd say, come on, Brian, come take a look. And after about 2 or 3 property tours, And all along, I'm talking to him about him. I'm educating him about multifamily because it was different than what he did. Finally, we found a property, 43 units, no big deal, that we both liked. And so that was our first deal together. So that kind of developed. It wasn't a big deal. It was about 2.8 million. We had to raise about $1.4 million in capital. We thought we could raise the $1.4 million. We weren't sure. We did. It was no problem. And that acquisition's gone great. And now Brian's kind of hooked because if you can think about, we've talked about economies of scale. So this project, 43 units, built 2006, so relatively new, doesn't have a lot of fundamental problems, right? Not Class A luxury. It's kind of more affordable housing, but 2006. They're all one bedroom, one bath units, which we actually love. And every floor plan is the same. So think about it. The listeners should consider. We go in to renovate the first unit. It might have taken us a week because we had to measure stuff. We had to figure out what we were doing, put it in a microwave, new countertops, replacing the toilet and all that. But once we did that first time, since all the other units were identical, we know exactly what material we need to order. And so at Home Depot, they basically have a standing order. This property is called the Cottages at Staunton Bridge. So we call up and we hey, we need 2 sets of Cottages at Staunton Bridge renovation. The next day, they're there on the dock at 7 a.m. and our construction crew goes, picks it up. So the renovation of these units, you can imagine if you have to renovate 10 houses, each house is different. The advantage of multifamily is you might only have 1 or 2 floor plans within a complex. So Brian, of course, really liked that because now we get in and out in about 3 days. We don't have to measure. We know what we need to order, and it really rolls. And so Brian and I did maybe about 5 or 6 deals here in Greenville. And of course, you then have to start keeping track of all the income and expenses, and you have to distribute money to investors. So we got an investor portal that does great. And I was kind of doing the financial accounting, and I could do it, but it wasn't elegant. I wasn't a skilled CFO type. So over time, at a real estate conference, best ever real estate conference, I met a guy, Dan Raleigh, who was from the Bay Area, moved to North Carolina. We started to become friends. It's only about 4 hours away. So I said, Dan, come on down to Greenville, take a look. And he started investing with us as an LP. And he had invested all over the country, and I could kind of tell he was about ready to try to leave the W-2. He's early 50s. He said he's worked for 31 years straight. About 3 weeks ago, he resigned his W-2 position, and now he's full-time real estate. But as Brian and I accumulated deals, the bookkeeping, the financial, the analysis started to become overwhelming, and we knew we needed somebody else. And I kind of knew Dan was ready to kind of make the jump. So now the last 2 or 3 deals, we brought Dan in. And so now it's Arn, Dan, and Brian runs the assets. I stay out of his way. Brian, whatever you want to do is cool with me. I mean, we agree, we have alignment on the overall investment strategy, our approach to investing, which for us is kind of long-term buy and hold, fixed rate debt, low leverage, cash reserves, kind of boring old school stuff. So we have alignment on the overall strategy, but then within let's call it the tactics or the action items. Dan takes care of the numbers. Dan takes care of the accounting and the financial analysis. Brian takes care of the actual operation of the property. And I go out and hunt deals and talk to people. And so we're all three right where our skill is the maximum and what we enjoy doing. So we've now got a complete team. Now, as we evolve, maybe it turns out we need to bring somebody else on, but it'll kind of happen organically. So right now, that's how it kind of developed. And I'm really happy I got Dan and Brian as partners because they more than carry their weight, and they take the stuff off my plate that I don't really enjoy doing.
Yeah, makes sense.
Yeah.
Tell me a little bit about the. So you described the overall strategy that you have. And when you say long-term hold, how long are we looking at? And then also, as far as the leverage, what is the formula you're looking for there?
So let me start by saying within the real estate industry, there's another debate. The first one we kind of talked about is cash flow versus equity growth. I think the other one is, can you time the market, or is time in the market the way to go? And for me, I've never believed I could time the market. I believe the top or bottom of any market isn't known until 6 to 12 months after it's happened. So I'm a strong believer in time in the market. Let's call it dollar cost averaging, to put it in stock terminology. You buy good properties in good quality locations and you invest over time and you set it up properly, and you're going to win. Generally, my experience in real estate is, and I've been through probably 3 or 4 cycles now, you get 5 or 6 years of kind of a bull market, a boom market. You maybe get a year or 2 of a little bit of retrenchment, a little bit of turbulence, and that's what I think we're in now. And then you get a year or 2 of kind of flat. And as all that does is set the plateau for the next run up. So, long term, do we think the cost of housing is going to go down? I don't see how you could really make any legitimate arguments that it's going to. So I don't see that happening. So in terms of our philosophy, how do you set yourself up to thrive long term and be able to withstand the rainy day that's got to come, right?
Yeah.
Or Murphy's Law, right? How do you set yourself up long term so you make safe, prudent investments? Because a little rain must fall. The economy doesn't always go up. There's always going to be some disturbance, some downtime. So how do you go about doing it? And so for us, it's fixed rate debt. When I got into the business, my dad told me the key to real estate, it's one of the few investments where you can get long-term fixed rate debt, where you know the cost of your capital and you can plan on it. So fixed rate debt. And what I would say with fixed rate debt is, if the numbers on the property work today and you have fixed rate debt, odds are they're only going to work better 5 years from now. Because essentially with the debt, 50% of your cost is fixed. And so then, yes, you got inflation, but inflation's working the rent as well as the other expenses. So if you could fix 50% of your, and debt isn't really an expense, but for this, let's call it an expense. If you could fix most of that, that's a big win in my opinion. And then we generally like to put 30 to 40% down on these deals. And in this market right now, with debt at about 7, we're closing $6 million, 2 different projects, new build to rent product, duplex here in Greenville. And we're paying 7% fixed rate debt for 5 years. To make those properties cash flow, we're having to put about 45% down.
Okay.
And so when debt's a little cheaper, maybe you could go to 30% down. Right now, you probably got to go about 40, 45. And while I'm not a cash flow is king investor, I do believe you need to buy these assets where they are cash flow positive. And the point of the cash flow isn't so much to put money in your pocket that you're going to spend. The cash flow positive is that protective layer when maybe rents drop a little bit or you have an unexpected expense. So the cash flow kind of protects that layer. The way I like to describe it is I want my properties to be self-supporting. Okay. So parents with teenagers, when you're thinking about getting them through college and launching them, what's the goal? You ultimately want them to be self-supporting, right? And it's the same thing with property, because if you buy properties that are self-supporting, meaning you don't have to infuse cash into them regularly, they're just going to run. They're going to pay for themselves. And 5 to 10 years later, it's not a stretch to say they're going to be worth more money. So that's kind of the formula that I've used. And it's been successful. And it's interesting. People, I'm sure many of your listeners are aware of some of the issues that have happened in the syndication space, primarily around floating rate bridge debt, which is kind of a very aggressive, high leverage. And I make the analogy, if we go back to 2006 and 7 and look at the subprime crisis, 2008 and 9, basically it was adjustable rate home mortgages with no qualification or credit standards that set up this frenzy that created a bubble that then burst. And I think it's similar to what has recently happened in multifamily, the floating rate bridge debt, which the debt amount was based on what they thought they could make the income 2 years ago, right? It's kind of phantom income, where with the fixed rate debt, you qualify based on what the property's actually doing. So I see some analogies and the result is the same. There are some people that are in trouble now, and I'm happy to say we don't have any floating bridge debt. We're all fixed rate debt. And our investors are happy. We're paying distributions on time, no capital calls. So if you go in and set it up properly, real estate is a fairly sure thing. Though investing, any kind of investing involves some kind of risk, which then leads to diversification, but that's topic for another time.
And all of the investments that you've been doing have been right there in the Greenville area?
Where I'm lead sponsor, correct.
Okay.
So I have raised capital for other operators. I love the Mountain West. I have deals in Boise and Colorado Springs, and then I have other ones in Charlotte, in Georgia. So the 2 markets that I've been most involved in is kind of the Mountain West. I don't have anything in Salt Lake City. Salt Lake's doing great, and the Southeast. But the ones where I'm the lead sponsor, which is basically where the buck stops, who actually has responsibility. It's all in Greenville. And again, that's kind of an old school thing that's been drilled into me. I think we all understand, your listeners understand in their communities, they could be in a really nice neighborhood and they could drive a mile away and go across a major boulevard, and all of a sudden the character of the neighborhood is different. So within any market, you have variance neighborhood by neighborhood, and in some occasions, street by street, or even block by block, the character. And so it's kind of an old school thought. There's a lot of data out there with the explosion of the internet and CoStar and all of these reports. There's a lot of data, but I don't think the data replaces what you actually see here and experience by being local. So we really like being in our market. The other thing, Keith, is I don't like to fly, so I'd rather drive a half hour to my property than have to get on a plane. But more seriously, the local knowledge is important, because your listeners could think about, they probably know areas in their community where a lot of homes are being remodeled, or this abandoned storefront is turning into this really cool coffee shop. And so you can see, you kind of know, okay, that area is going to be good. People are investing capital. It's going to improve. And so if you know your market, I think you have that competitive advantage. So when Brian and I go into a building, we know what those units will rent for.
Yeah.
We know what those units will rent for when we fix them up. And since we're fixing units up in this market, we actually know what it's going to cost. And so we just feel more comfortable in Greenville. And I moved to Greenville because of the quality of life. It's got a great downtown. It's in the Blue Ridge Mountains, and we love the outdoor activities, but it's very dynamic economy. It's generally rated in the top 5 kind of smaller tertiary multifamily markets in the U.S. So the local knowledge, plus that it's a strong market, we like it. My partner, Brian, is here. He only wants to stick in Greenville. So that's kind of what we do.
Yeah. It makes sense with Brian having his property management right there as well. All of because when you start to stretch out and you start to go into some of these other areas, like you said, it is kind of a peculiar thing. You'll be on one block, everything will be good. You go right around the corner and it's totally different story. And so you know the market, and that's important.
Yeah.
Maybe if we could talk a little bit about, you made that progression from single family to multifamily, from self-managing to, now utilizing Brian's property management. Can you maybe talk a little bit about that and what, some of the lessons that I guess maybe you learned along the way with respect to that?
Yeah, great question. So, one, with property management and with any business people understand this. To the degree you can implement systems, it increases efficiency and productivity. And I'm not a systems guy. I'm kind of a freewheeler, that there's terms, what do they call it? There's the visionary, and then there's kind of the implementer or the operator. I'm kind of more the visionary type. So I think to run any business, and real estate is a business, to the degree you can implement systems and processes, you're going to be better off. That will allow you to scale. The other thing I would say for me is, as a self-manager, I would kind of develop a personal relationship with my tenants. And most of them have been great. And my kind of personal approach would be, if they paid the rent on time, didn't cause any problems, didn't cause me any problems, I was pretty much just happy to let them sit there and just keep paying the rent. So I was never very aggressive about raising the rent. And generally, I'd have tenants for 5, 6, 7 years, and they'd leave when they bought a house, which was fine. I was happy for them. It's a big step in everyone's life. But for me, I wasn't really motivated to increase that rent, because really I was investing for them for the long-term wealth. I didn't really need the extra $50 a month. To me, it didn't matter. Where I think when you're dealing with investors, you have a little higher responsibility to maximize returns for them.
Correct.
And so when it's third-party property management or a formal property management company, the whole dynamic between the resident tenant and the owner shifts a little bit. At least it did for me. So for our investors, having kind of a professional, systematic approach works better. And the other thing I would say is, we appreciate our tenants. We maintain our properties. We give them value. And we're respectful of them in that one of the first buildings we bought, maybe the rents were about $650 a month, and market may have been about $900. So we didn't just go in there and give everybody notice to vacate, or, hey, your rent's $900 starting next month. We kind of worked with them and systematically over time slowly increased the rent. So we were able to increase the rent roll while allowing these folks to stay in their homes. And so we try to create a win-win. And as a property owner, as a multifamily owner, two of your biggest expenses are vacancy and turnover. So if you can keep your existing tenant base, have no vacancy, not have to spend a lot of money turning the unit over, and still get incremental rent increases, the investors are winning, but you're also conducting business with some kind of level of character and integrity. And I'm not Mother Teresa, but I believe people who have achieved a certain level of financial success should have some consideration for people who maybe aren't quite as fortunate or not quite as blessed. You know, show a little class and respect, and you know, try to treat these people with respect. So that's how we kind of approach it. So from the investment point of view, having kind of professional management with policies and procedures works better. For me, just doing it on my own, I didn't really conduct it as much as a business as I should have.
Yeah, makes total sense.
Yeah.
And I was the same way with mine as well. You kind of, you get kind of in that spot where it's like, I could increase the rent, but and sometimes we let that go a little too long.
Yes, for sure. And there has to be a balance. And that's for each investor to kind of figure out, where within that range is the best place for them to be.
Yeah, for sure.
Yeah.
Well, Arn, this has really been great. I appreciate you being on the Wealth Flow. How can people find out more about you, more about Spark Investment Group.
Yeah. So I'm very active on social media, either LinkedIn or Facebook under Arn Cenedella or my company name, Spark Investment Group. Website is investwithspark.com. And always love talking real estate. So happy to help other investors, do well and prosper.
Great. And I've got two more questions for you that I ask every guest. One of them is just any advice you would give somebody who's just starting out in their investment journey.
Yeah. So, one, educate yourself, get some level of education, um, find trusted advisors that your gut instinct, your intuition, your life experience tells you these are solid people and they're actually working. So as an investor, it's certainly going to be a broker. Try to find a good real estate broker who deals in investment, and then also find a good debt broker to help you get the best financing. I think the other thing I would say is never let anybody pressure you. There's going to be the next greatest deal next week. So if you feel pressure, maybe step back a little bit. And then I think the other thing, some gurus talk about go big or go home, or the sooner you go bigger, the better. That's not my philosophy. I believe there's an incremental path to growth and knowledge. So, uh, if you're going to buy your first rental property, maybe it's a single family, maybe it's a duplex, triplex, quad. Go ahead, do that. Try that out. See if you like it. See what your experience is. And then if you like it and you want to do more, scale up or accumulate more, by all means, do this. But I wouldn't recommend anybody go out, buy a 40-unit building as their first rental property investment. I think there's a safer, more systematic way to do it. So, education, find some trusted professionals, start small, get your feet wet, gain a little experience, because I can tell you, actually owning rental property as opposed to reading Bigger Pockets or reading a book, you'll learn more in that first year of owning rental property than you do with any book. So start small, because if you make a mistake, and mistakes are okay, we all learn from mistakes. I've made investing in mistakes in my day. But the one thing I did was I never made a mistake that I couldn't withstand, right? So you may make a mistake, but live to fight another day. You may get a punch in the gut, but don't let it be a mortal wound. And with my investors, passive investors, LP investors, and they're generally doing fairly well financially, have capital to invest, I always tell them, don't go all in on your first deal. If you have a pile of capital you want to invest, put some here with this operator, try some with this next operator, spread it around a little bit, and you'll see which people actually produce for you. So no need to go in, start small, get your feet wet, and then move on if it works for you. And it's not necessarily for everybody.
Yeah, no, that's great advice.
Yeah.
How about a book recommendation? Doesn't have to be real estate related, but it certainly can be. Just something that's been impactful that you've read recently, or it doesn't even have to be recently. So
yeah. So I do a lot of personal growth work. It's something that I like doing, and so a book that I read years ago, I think Eckhart Tolle, The Power of Now. And what it kind of talks about is, to the degree you can kind of focus on the here and now and the present, everything's okay. And people get in trouble if they're kind of living in the past or worrying about the future. So to the degree you can stay in the present and kind of accept what it is, it's better. So The Power of Now by Eckhart Tolle is a pretty good one.
Okay, fantastic. I don't think I've had that recommendation yet, so
Probably
I'll have to check
not. That one's a little strange, but I gave it to you anyway, Keith.
No, that's awesome. All right, Arn. Well, thank you so much. Appreciate you being on the show today.
Yeah, pleasure to meet you, and appreciate your time. Thanks, bud.
Thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.